AI isn't the future. It's already running your bank. From fraud detection to loan approvals, machines are deciding your money. Today, I'll break down how AI controls your finances in 2025, and how to protect yourself. When you think of artificial intelligence, your mind might leap to science fiction, sentient robots or super-intelligent computers. But the reality is far more subtle, and it's already deeply woven into the fabric of your daily life. Nowhere is this more true than in the world of finance. Every time you swipe your card, apply for a loan, or chat with your bank's support line, there's a high probability that an AI is working silently in the background, making decisions that directly impact your money. This isn't a futuristic concept, it's the present-day reality of banking. The journey of AI in finance didn't happen overnight. It began decades ago with simple rule-based systems, rudimentary algorithms that would flag transactions based on a rigid set of if-then conditions. A key milestone was the application of neural networks in the 1990s, which could learn from data and identify complex patterns far beyond human capability. The explosion of big data in the 21st century, fueled by the internet and mobile banking, provided the rocket fuel. Suddenly, banks had access to trillions of data points, a playground for AI to learn, adapt, and evolve at an unprecedented rate. This transformation is global. From the fintech hubs of Silicon Valley and London to the mobile payment revolutions in Nairobi and Shanghai, AI is reshaping financial services worldwide, creating a more interconnected and complex financial ecosystem than ever before. So let's pull back the curtain and look at the three primary ways AI is touching your money right now. First, and perhaps most critically, fraud detection. In the digital age, our financial data is constantly on the move, creating countless opportunities for criminals. The scale of the problem is staggering, with global payment fraud losses costing consumers and businesses tens of billions of dollars every year. It's a relentless, high-stakes battle, and AI is the financial industry's frontline soldier. Here's how it works. Every time you make a purchase, a torrent of data is generated. The amount, the merchant, the location, the time of day, the device you're using. An AI model trained on billions of past transactions analyzes this new data point in milliseconds. It's looking for anomalies, for anything that deviates from your established pattern of behavior. Think of it as a digital fingerprint of your spending habits. If you live in Ohio and primarily buy groceries and gas, a sudden $3,000 purchase of luxury watches from a website in another country at 4 a.m. will raise a giant red flag. The AI calculates a risk score in real time. If that score crosses a certain threshold, the system can take immediate automated action. It can block the transaction, freeze your card, and instantly send a push notification to your phone asking, "Did you just try to make this purchase?" This speed is something no team of humans could ever replicate. It's the difference between catching fraud as it happens and discovering it on your monthly statement long after the money is gone. Let's consider a real-world scenario. Sarah, a freelance writer, had her credit card information stolen in a major retail data breach. She was completely unaware. Days later, the thief attempted to use her details to buy untraceable gift cards online, a classic move for fraudsters. The bank's AI, however, noticed several anomalies. The purchase was made from an IP address thousands of miles away. The transaction amount was unusual for Sarah, and it was part of a rapid series of attempts at different online stores. The AI immediately blocked the card and alerted Sarah. She lost nothing. This is AI at its best, a silent guardian protecting your finances. But this powerful system isn't flawless. Its vigilance can sometimes become overzealous, leading to what's known as a false positive. Imagine you're on a once-in-a-lifetime vacation. You try to buy a unique local craft, but your card is declined. Your bank's AI, seeing a transaction in an unusual location, has mistaken your legitimate purchase for fraud and blocked your card. Now you're left embarrassed at the counter and facing the hassle of calling your bank to sort it out. This is the fundamental tension in fraud detection, the trade-off between security and convenience. Banks are constantly fine-tuning their AI models to minimize these false positives without letting actual fraud slip through. As Dr. Evelyn Reed, a data scientist specializing in financial systems, explains, it's a perpetual cat-and-mouse game. Fraudsters are incredibly adaptive. They use AI themselves to find vulnerabilities, so our models must constantly learn and evolve. Every time a customer confirms a legitimate transaction after an alert, they are providing valuable feedback that makes the AI smarter. Next, let's talk about access to credit, the world of underwriting. For decades, the gatekeeper to loans, mortgages, and credit cards has been a single, powerful number: your FICO score. This score is based on a relatively narrow set of data points from your credit report. While useful, this traditional model can be a blunt instrument. It often fails to capture the full financial picture of an individual, leaving many creditworthy people out in the cold. This is where AI is rewriting the rules. AI-powered underwriting goes far beyond the FICO score, analyzing thousands of data points to build a much more nuanced profile. The goal is to identify responsible borrowers who are overlooked by the old system. Consider the case of Maria, a talented software developer who recently immigrated to the US. She had a great job, but no American credit history. When she applied for a small loan to buy a more powerful computer for her work, traditional banks turned her down flat. However, she then applied to a fintech lender that used an AI underwriting model. This AI analyzed the consistent, on-time payments from her clients flowing into her bank account and her steady rental payment history. The algorithm concluded she was a low-risk borrower, and she was approved. For Maria, AI opened a door that the traditional system had slammed shut. But this expansion of data brings significant risks, particularly concerning fairness and bias. AI models learn from historical data, and if that data reflects past societal biases, the AI can learn and even amplify them. For example, if historical lending data shows that people from a certain neighborhood were denied loans at a higher rate, perhaps due to discriminatory practices like redlining, an AI might learn to associate that zip code with higher risk, perpetuating the cycle of disinvestment. This is known as proxy discrimination. The black box nature of some complex AI models exacerbates this problem. If you're denied credit, the lender is legally required to provide a reason. But what if the reason is simply the algorithm determined you were too high risk? That lack of transparency is a major concern. As Ben Carter, a leading consumer rights advocate, puts it, "We cannot trade fairness for efficiency. These underwriting algorithms need to be transparent, explainable, and rigorously audited for bias. Without robust oversight, we risk creating a new, high-tech form of discrimination." Finally, AI is transforming the most common way you interact with your bank: customer service. In the past, any question meant picking up the phone and waiting on hold. Today, your first point of contact is increasingly an AI. Chatbots and conversational voice AI are now handling a huge volume of routine interactions, driven by 24/7 availability and massive efficiency gains. They use sophisticated natural language processing to understand your intent. When it works well, it's incredibly convenient. Imagine it's late at night and you have a moment of panic. You can't find your debit card. Instead of waiting until the bank opens, you can open the app, type "freeze my card" into the chatbot, and within seconds, your account is secured and the bot is walking you through the next steps. It's fast, simple, and effective. However, we've all experienced the other side of this coin: the frustration of being stuck in a conversational loop with a bot that doesn't understand your problem. You ask a slightly complex question and the bot responds with, "I'm sorry, I don't understand, please try rephrasing." This is where the limitations of current AI become painfully clear. The good news is that these systems are evolving. The latest generation can handle more complex queries and even perform sentiment analysis, detecting frustration to escalate the call to a human. This points to a hybrid future. As customer experience strategist Sarah Jenkins notes, the ultimate goal isn't to eliminate human agents but to empower them. Let AI handle the simple tasks. This frees up the human team to focus on complex, high-empathy situations where they are irreplaceable. So, from the silent, instantaneous decision to approve or deny a transaction, to the complex calculations that determine your access to credit, to the chatbot that answers your late-night query, AI is no longer on the horizon of banking, it is the foundation of its modern operations. It acts as our financial guardian, our gatekeeper, and our frontline assistant. This integration brings with it a powerful duality. On one hand, AI offers unprecedented security, efficiency, and the potential for greater financial inclusion. On the other, it presents profound challenges: the risk of errors, the danger of algorithmic bias, and the frustration of technology that fails to understand us. As consumers, understanding where and how these systems work is the first step toward navigating this new landscape. The invisible hand of AI is shaping our financial lives every single day, and being aware of its presence, its power, and its pitfalls is more important than ever. The world of lending has undergone a seismic shift. For decades, getting a loan was a slow, deliberate process, a face-to-face negotiation based on a handful of key documents, your pay stubs, your tax returns, and that all-important credit score. An underwriter would manually review your file, a process that could take days, even weeks. Today, that entire timeline has been compressed into seconds. Modern lending platforms, powered by artificial intelligence, can ingest, analyze, and act upon a staggering volume of information. We're not just talking about your credit report anymore. AI models can weigh over 1,000 different data points to decide on loan offers, determining your financial future in the time it takes to refresh a web page. This includes traditional metrics, but also a vast array of alternative data. Your rental payment history, the stability of your income streams, your educational background, even the digital footprint you leave when you apply. From the lender's perspective, this is a revolution in efficiency. It allows them to process millions of applications at a scale previously unimaginable, theoretically leading to a more inclusive financial system where more people can access credit more quickly. The goal is to build a more nuanced and accurate picture of an applicant's creditworthiness than a single three-digit number could ever provide. That speed and power are transformative, but they come with a profound challenge, a lack of transparency that can mask hidden biases. This is often referred to as the black box problem of AI. The very complexity that allows these models to find subtle patterns in data also makes their decision-making process incredibly difficult, sometimes impossible, for humans to fully understand. Even the engineers who build the models can't always trace the exact path of logic that leads to a specific approval or denial. This opacity is dangerous because AI learns from the data it's given. And if that historical data reflects decades of human bias, the AI will learn not just to replicate but to amplify those biases with ruthless mathematical efficiency. For example, if a bank's past lending data shows a pattern of denying loans in certain neighborhoods, a practice known as redlining, the AI may learn to associate a zip code with risk, creating a new form of digital redlining that penalizes applicants based on where they live, not their individual financial health. This isn't a theoretical risk. We see it in consumer stories. Take Sarah, a successful freelance web developer with a consistent six-figure income and a FICO score of 780. She was denied a simple small business loan by an automated system. The reason? The AI model, trained on decades of data from salaried employees, likely flagged her variable project-based income as a sign of instability, failing to understand the realities of the modern gig economy. For Sarah, the speed of AI wasn't powerful. It was a swift, unexplained rejection that stalled her business growth. The consequences of this are very real. It explains how two people with the exact same FICO score can apply for the same loan and receive vastly different offers. The FICO score is just one input among hundreds, and often, it's not even the most important one in an AI's calculation. Let's walk through a scenario. Meet Alex and Ben. Both have a solid FICO score of 750 and are applying for a $30,000 auto loan. On paper, they seem identical, but the AI sees much more. Alex has been a salaried employee at the same large tech company for 8 years and lives in a zip code with a high average income. He fills out his application on a new laptop during his lunch break. Ben is a self-employed contractor. His income is actually 20% higher than Alex's, but it fluctuates month to month. He lives in a more diverse middle-income neighborhood and applies for the loan late at night from his 3-year-old smartphone. The AI model begins its analysis. It sees their identical FICO scores, but then it starts weighing the other signals. For Alex, it sees a long, stable employment history, which it correlates with low risk. His zip code and the fact he's using a new computer are also positive signals based on the model's training data. For Ben, the AI flags his variable income as a potential risk factor. His zip code might be associated with slightly higher default rates in the historical data. Even applying late at night on an older device can be a negative signal, as some models have correlated this behavior with financial desperation. None of these factors alone would be a deal breaker, but the AI combines them, and a new risk profile emerges. Alex is deemed a prime borrower and is instantly approved with a 4% interest rate. Ben, despite his higher income and identical FICO score, is offered the same loan at 8.5%. He wasn't denied, but the AI decided he was a greater risk and priced that risk into his offer. This difference in percentage points has a massive impact on your wallet. It directly affects the interest rate you pay, which determines the total price of credit and the long-term cost of the loan. Let's do the math for Alex and Ben's $30,000 loan over 60 months. Alex, with his 4% rate, will have a monthly payment of about $552. Over 5 years, he'll pay a total of $3,150 in interest. Ben, with his 8.5% rate, will have a monthly payment of $615. Over the same 5 years, he'll pay a staggering $6,900 in interest. That's a difference of over $3,700. Paid for by Ben, simply because an algorithm interpreted his lifestyle and work patterns as being riskier. This isn't just about one car loan. The price of credit has a compounding effect on your financial life. A higher monthly payment increases your debt-to-income ratio, which is a critical factor when you apply for other forms of credit, like a mortgage. Ben may find it harder to get approved for a home loan down the line, or be offered a higher rate there as well, perpetuating a cycle of more expensive debt. When this happens at scale, across millions of applicants, it can reinforce and even widen societal wealth gaps, limiting economic opportunity for entire segments of the population. So what can you do? You are not powerless in this new landscape. Federal regulations like the Equal Credit Opportunity Act provide crucial protections. This law mandates that if you are denied credit or given less favorable terms, the lender must provide you with an adverse action notice explaining the specific reasons for the decision. When an AI is involved, these reasons can be frustratingly vague, but you should always demand this notice in writing. It's your legal right and your first piece of evidence. Scrutinize the reasons given. If they don't make sense, challenge them. The next step is to become the auditor of your own data. You are entitled to a free credit report from each of the 3 major bureaus, Equifax, Experian, and TransUnion, every year. Get them, read them carefully. A simple error, like a misspelled name or a debt that was already paid off, could be the single data point that caused the AI to give you a negative assessment. If you find an error, dispute it immediately with the credit bureau. Furthermore, you can and should ask the lender what primary data sources were used in their decision. Was it just your credit report, or did they use alternative data from a third-party provider? You have a right to know what information is being used to judge you. Regulators are increasingly pushing for what's called explainable AI, or XAI, which forces lenders to build models that are not complete black boxes. The goal is to ensure that every automated credit decision is auditable and can be traced back to specific verifiable factors, upholding your right to a fair and transparent process. In investing, hedge funds and robo-advisors use AI to find patterns at scale. Retail platforms now offer AI-driven advice, sometimes marketed as smarter trading. Be cautious, models can overfit and fail when markets change. Never blindly trust auto trading. Check fees, assumptions, and limits. The integration of artificial intelligence into our financial lives promises unprecedented efficiency and personalization. But this powerful technology is a double-edged sword. As we hand over more of our financial decisions to algorithms, we must also become acutely aware of the new landscape of risks that emerge. These aren't just theoretical problems, they are active challenges that can have profound consequences on your wealth, opportunities, and fundamental rights. Understanding these risks isn't about fearing technology, it's about empowering yourself to navigate this new world safely and effectively. Let's begin by pulling back the curtain on the most foundational risk of all, your data. The first and most pervasive risk is data privacy. When we say banks collect more data than you think, we're not just talking about your account balance and transaction history. They are building a digital mosaic of your life. This includes your geolocation data from their mobile app, your spending habits which reveal your lifestyle, and sometimes even data purchased from third-party brokers about your online browsing, social media activity, and major life events. Why? To construct a hyper-detailed profile that predicts your behavior. This profile is then used for everything from targeting you with specific credit card offers to assessing your risk level for a loan. The more data they have, the more accurately they believe they can predict your financial future. But this massive aggregation of sensitive information creates a honeypot for cybercriminals. A single data breach could expose not just your financial details but the very patterns of your life, leading to sophisticated identity theft that can take years to unravel. This leads directly to the second major risk, algorithmic bias. An AI system is only as good as the data it's trained on, and historically, financial data is riddled with societal biases. Decades of discriminatory practices like redlining are embedded in the historical loan data fed into these new systems. The AI, with no understanding of historical context or fairness, learns these patterns. It might learn that applicants from certain zip codes are higher risk, or that people who shop at discount stores are less creditworthy. It can create correlations that act as proxies for protected characteristics like race, gender, or age. The result is that algorithmic bias can disadvantage entire groups, creating digital redlining that is far harder to detect and prove than its historical counterpart. Because of the black box nature of many complex AI models, even the banks themselves may not be able to explain precisely why a specific decision was made, making it incredibly difficult for a consumer to challenge a potentially discriminatory outcome. We spoke with a consumer rights advocate who highlighted the challenge. She explained, "The burden of proof is shifting to the consumer in an unfair way. In the past, if you felt you were discriminated against, you could point to a person, a loan officer. Now the bank can point to a complex algorithm and claim objectivity, but if the algorithm was trained on a biased world, it will project a biased future. We need regulations that demand not just accuracy, but explainability. If a bank cannot explain in simple terms why its AI denied someone a loan, that decision should be considered invalid until a human can conduct a fair and thorough review." Finally, there's the risk of over-automation and the removal of human oversight. The drive for efficiency means more processes are fully automated, from fraud detection to loan processing. While this reduces costs, it also removes critical checkpoints where human intuition and common sense can catch errors. A simple typo in your income, a mistaken fraud alert that freezes your account while you're traveling, or a glitch that miscalculates your credit score can spiral out of control within a fully automated system. These errors can propagate almost instantly, affecting your ability to make crucial payments or secure opportunities. Without a human in the loop to question an anomalous result, small errors can cascade into significant financial hardship, and you might be left fighting a faceless system to correct a mistake that a person would have spotted in seconds. Faced with these risks, it's easy to feel powerless, but you are not. Knowledge is your shield, and proactive engagement is your sword. You have the power to protect your data, question decisions, and leverage these same AI tools for your own benefit. So what can you do? First, be skeptical of instant approvals and demand transparency. An instant yes or no from an algorithm might feel convenient, but it lacks nuance. Always compare offers. Don't just look at the big national banks. Check with local credit unions and community banks who may use more personalized, human-driven assessment models. If you are denied credit or given unfavorable terms, do not simply accept the automated rejection. You have a right to know why. Under the Equal Credit Opportunity Act, lenders are required to provide you with the specific reasons for their decision. Call them, ask for that reason, and most importantly, ask for a human review. State clearly that you believe an automated system may not have captured your full financial picture and you want your application reviewed by a person. Second, fight fire with fire. Use AI tools yourself for budgeting and running financial scenarios, but always verify the results. There are incredible apps that can analyze your spending, help you create a budget, and simulate how different saving strategies could play out over time. Use robo-advisors to get low-cost investment ideas, but treat these tools as your co-pilot, not the autopilot. Use them to generate ideas and organize your information, but then do your own research. Verify their suggestions. Understand the assumptions they're making. By using AI as your personal analyst, you can turn the tables and leverage its power to enhance your own financial literacy and decision-making. Third, and this is crucial, keep a human advisor in the loop when the stakes are high. For major life decisions, buying a home, planning for retirement, managing an inheritance, the nuanced understanding of a human professional is irreplaceable. An AI can calculate compound interest, but it can't understand your fear of risk, your dreams for your children's education, or the complex family dynamics behind an estate plan. A good human advisor acts as your advocate and your interpreter. They can help you make sense of AI-driven recommendations and can fight on your behalf if you run into issues with an automated system. Their value lies in their empathy, experience, and their legal and ethical duty to act in your best interest. Finally, know your rights and be a conscious consumer. Familiarize yourself with regulations like the Fair Credit Reporting Act and the work of agencies like the Consumer Financial Protection Bureau. If you believe you've been treated unfairly by an automated financial system, file a complaint. These complaints create a data trail that helps regulators identify patterns of bias and take action, and take control of your data. Regularly review the privacy settings on your financial apps. Opt out of data sharing wherever possible. Be mindful of the permissions you grant. By taking these small, consistent steps, you not only protect yourself, but also send a clear message to the industry that privacy and fairness are not negotiable. The future of finance will be shaped by AI, but its direction, whether it serves humanity or simply the bottom line, will be determined by how actively we all participate in holding it accountable. AI is already deciding how your money moves, but knowledge is power. Tell me in the comments and don't miss the next video on automating your finances.